May's headline consumer prices increased by 4.2% year-on-year, mainly because of rising energy prices. You can see the trend at the chart at the right, and it's the first time in 3 years that inflation climbed more than 4%. But when you look at the core consumer prices, which removes food and energy prices, it currently sits at 2.9% year-on-year. Its monthly gain was 0.1% below estimates. So at least there's some positive signs that when you remove energy prices at the consumer prices, the monthly gain isn't very drastic. And initially, markets were in the negative territory, but it jumped after Pakistan Prime Minister Shehbaz Sharif said that US and Iran have agreed to end the war. Much of the inflation surge is because of energy prices. It jumped 23.5% year-on-year. Next, the upcoming Federal Open Market meeting will be held on June 17th. They're mostly expected to hold the interest rate, currently at 3.5 to 3.75%, and the likelihood of a rate hike might be in December this year if the war persists. So that was consumer prices. Let's look at producer prices. May's headline producer prices increased at 6.5% year-on-year, and when you look at the core one, removing food and energy, it's also not low at 4.9%. This makes sense because when businesses face higher fuel prices, everything else will also get an impact. For gasoline prices at wholesale level, it's quite similar to consumer level. It jumped 23.4% year-on-year. The European Central Bank on 11th June hiked interest rate by 0.25%, a quarter point, now at 2.25%. It's because of the Iran war pushing inflation levels higher in May. The Eurozone headline inflation is 3.2% year-over-year now, and this hike is mostly expected by markets which priced in an almost 100% chance. The European Central Bank also increased inflation forecast and revised the economic growth forecast downwards by almost half of last year's. 2025's growth came in at 1.4%, and now they're forecasting 0.8% for this year. The outlook remains uncertain. There's upside risk for inflation and downside risk for economic growth. This puts the Eurozone area at a very tricky spot. For some background, obviously because of Iran war, and it's almost 4 months now, it caused the global energy price shock. The closure of Strait to Hormuz increased oil prices by a lot, and the disruption on supply chain caused frictions in supply of oil to the rest of the world. The interest hike was a significant moment. It's the first European Central Bank hike since 2023, and because they've risks to inflation and growth, how far can the tightening cycle go? If they tighten too much, there will be negative impact on growth. But if they don't respond, inflation might pick up a lot. The UK's economy shrank by 0.1% month-on-month in April due to the impact of Iran war. The biggest reason is contraction in services activities. Construction increased a little, production showed no growth. So in services, the biggest contributor to the decline was a drop of 9.1% in sports, amusement, and recreational activities. Companies in manufacturing, wholesale, transportation, and travel agencies all faced with the impact. There's a lot of cancellation of sports events. The common theme is because of the increase in prices due to the Middle East conflict. The high fuel costs altered UK's growth trajectory, and motorists cut consumption because of high pump prices. That shows that their purchasing power isn't strong. And the last point is UK is like most of Eurozone countries being net energy importer. They're particularly vulnerable to energy shocks. But this time around, like Germany, UK's energy regulator provided some support and put a cap on how high the energy prices can go. Because of that, inflation eased to 2.8% year-on-year. Look at the trend at the chart on the right. It was 3% at start of the year to 3.3% and now 2.8%. But from July onwards, the price cap will increase by 13%. Energy providers will pass on the newly incurred cost to consumers. This should reflect in an increase in consumer prices. On to China. Maize producer prices increased by 3.9% year-on-year. It's the fastest pace in nearly 4 years. Few reasons are because of surging raw material costs, Iran war, and the high demand in AI. On to fuel and power prices first. Purchasing power for fuel and power climbed 10% year-on-year. These feed into producer prices. And for AI's high demand, prices lifted because of the surge in demand in computing power and tech equipment and semiconductors. Maize consumer prices increased by 1.2% year-on-year. Gasoline prices for consumers are quite similar to US. It jumped 23.5% year-on-year. China is different compared to US and Eurozone. Look at the core consumer prices, again, removing food and energy prices. It's at 1.1%, only 0.1% lower than the headline figure. Overall, inflationary pressure from the high energy cost is not strong because domestic demand is weak. Energy prices in China aren't really moving headline inflation much because domestic demand is weak. Because of further reflation risk, it'll pressure companies' profit margins because household consumption is low due to the ongoing property market slump and weak job markets. Chinese factories are being squeezed from both sides. Firstly, the rising costs, and next, the lack of pricing power to pass on the cost to consumers. This will continue until domestic demand recovers, and household saving rate is at very high level. So that means spending is very low. Domestic consumption is a key driver that China's economy needs. But the good thing is, May's trade growth is very good. Overall, exports increased by 19.4% year-on-year because of the high demand in AI-related products. Just to name two, exports of integrated circuits increased by 110%, and exports of high-tech goods increased by 50%. Even shipments to US increased by 35.4%. And one good thing that China has been benefiting from because of the tariffs hike from the US on the entire world. Southeast Asian countries and China benefit from structural advantages, meaning it's cheaper for Southeast Asian countries to buy from China than the US. This is a good support for China's exports. Overall, because of strong exports, China has a healthy trade surplus. The trend is at the chart on the right. So far, exports have been helping China's economy because overseas buyers are rushing to lock in supplies. They want to stockpile before energy costs climbs even higher. But this might not sustain once the momentum fades, and also when Strait of Hormuz opens up, because the key organic growth, which is domestic consumption, in China is weak. You can already see growth slow across the board in April. Just to name one, retail sales recently posted the weakest gains in years. So looking ahead, domestic demand is the problem that the government needs to solve. And one key reason is the persistent weak job market and the property prices issues. Lastly, updates on Iran war. The US and Iran have agreed on a deal to end the war and permanently terminate military operations on all fronts, even on Lebanon. Official signing will be on June 19th. That's if there's no changes again in between. President Trump said that after the signing, Strait of Hormuz will open and oil will flow to the world. And if Iran stops their nuclear plans, even Europe's E4, which are UK, France, Germany, and Italy, are ready to lift sanctions.